Hello, everyone. Welcome to today's session, a 2026 market update with Jeff Buchbinder. He is the Chief Equity Strategist at LPL Financial. We're really excited to have him back as a returning speaker. The webinar is hosted by Lumina Financial Strategies, and your moderator today is Allison Fleming, President of Lumina Financial Strategies. Allison is a certified financial planner practitioner, and for those of you who may be joining us for the first time, please allow me to introduce her. Allison has been a financial advisor since 1989 and serves clients in 29 states across the country. She holds a bachelor's degree in speech communication from Cal State Long Beach and believes that we must always adapt to the changing environment, remain current, and take advantage of opportunities to improve our clients' lives. Our local motto, be a long-term thinker, not a short-term worrier, serves as the cornerstone of her discussions. With that, I'll go ahead and hand it off to you, Allison.
Thank you, Caress. I appreciate you doing our introduction as usual. Welcome everybody to our webinar here on this lovely Wednesday afternoon. I was out in Palm Desert for our company conference over the last couple of days. I got home this morning and boy, I tell you, Palm Springs, 115 degrees when we got there on Sunday. So glad that I'm back in San Diego again. So before we go ahead and get into our presentation with Jeff, why don't I go ahead and introduce you to our team. And there we are. So we have Miles Fleming, who's our Executive Vice President, Insurance Specialist, particularly specializing in Medicare. We have Britt Stevens, our Vice President, and Peter Fink, our resident stock broker. We have Damian Feldman, who's the Client Experience Manager that you will talk to whenever you call in or he bugs you for appointments. Terry Jocelyn's our Executive Assistant Administrative Manager here in the office, and Maddie Uoa is up in our San Pedro location as an Administrative Assistant up there. Kaylee Levin is our Client Care Coordinator here in San Diego. And then Lucy Adame is also up in our San Pedro location. And finally, Caress Vera, the voice from the sky, the runner of webinars and all things image related, working on a revamp of our website. More to come on that one quickly. So that's our team. Let me go ahead and make sure that you're fully disclosed. So everybody speed read that 100%. And with no further ado, I would like to go ahead and introduce you to Jeff Buchbinder. Jeff has been with LPL for quite some time. He was one of our first webinar speakers. We started our speaker series in 2020 during COVID. And the last time that Jeff presented for our clients was actually in 2021. So Jeff, thank you again for coming back. Thank you for being there. Thank you for all the things that you and your team do. I'm going to go ahead and just turn it over to you because I know you've got a lot of things you want to share with our audience, and we will have time for questions at the end. So you go ahead and take it away. I'm going to go off camera and just let me know if you need me to pop back in.
Very good. Thank you so much, Allison. I greatly appreciate it. And thanks to all of you for joining. It's great to be with you here. I think I'm at the opposite end of the spectrum. It is not 115 degrees here in Boston, but we did break 50 today. So that was pretty exciting for everyone here. We haven't had too many 50-degree days over the last few months. What I'll do for you today is just walk through LPL's outlook for the economy and stock and bond markets, and then we can take some questions at the end. I think it goes without saying that this is a difficult environment to make forecasts in, given what's going on in the Middle East. But hopefully these comments will help give you some perspective that can be helpful for what the world might look like after this conflict is over. Hopefully it will not go on too long. So we titled the Outlook publication that we put out, what is it now? 3 months ago? Put out 3 months ago. And what's really interesting here, I put in some new charts to be current, but I left in some of the charts from December because I think it's really interesting to show the contrast in terms of what's changed. Now, Policy Engine was the title before it, and that certainly is still relevant, policy, but we certainly did not predict the military operation that we're now seeing in Iran. So policy is sort of moving to the back burner, we'll say. Even artificial intelligence is moving to the back burner a little bit in terms of its ability to drive markets. And really, right now, it's just all about oil. In fact, the title of the economics section before was actually the more things change, the more they stay the same. Because really, 2025 was policy driven. The policy was really more around election. It was not really stimulus related policy, but it was similar in some respects. So coming into 2026, we thought, well, it's going to be about policy again. It's going to be about the Federal Reserve again. And then it's going to be about stimulus and then, the upcoming midterm elections. I changed that because it's not about how similar this year is to last year anymore. It's really about the impact that the events in the Middle East are going to have on the economy and markets. And certainly we're all feeling it, seeing what's happened to gas prices here over just the last few weeks. So this chart shows you GDP forecasts that we put in at the start of the year. And what's interesting here is we have become more optimistic about growth, despite the fact that high oil prices are certainly going to slow down consumer spending just a bit, and they're also going to impact corporate profit margins. As I'm sure many of you know, it's not just high oil prices, which of course translate into prices at the pump, and at least for me, because my house is heated with oil, home heating. And we still need heat, unfortunately, here in Boston in mid-March. So despite the fact that our growth outlook is maybe just slightly less robust now than it was a month ago, it's still actually a good bit above where it was when we created this slide. It's really going to be pretty easy in all realistic scenarios for what's going to happen in the Middle East, I think, for the US economy to grow 2%, because the combination of AI investment from the big tech companies and the fiscal stimulus from the one big beautiful bill, which is coming, it's already coming, it's already flowing, right? Those dollars are going to be spent. So that is economic growth. The numbers are huge. I'll share more about that in a little bit. Now, we thought that this little dip in Q4 would, quickly lead to a rebound, kind of in the, call it Q1, Q2 range. You could probably push that out just a little bit. The stimulus is still pushing growth up. The AI investment is still happening, but high oil prices are certainly going to slow the growth. And by the way, we're not getting Fed stimulus as quickly as we thought we would either. So those are some of the factors that really shape our economic outlook. Of course, I alluded to it, inflation, important for the economy and the markets. Remember, we had the government shutdown a couple months ago, and it was delaying data. We're in another one now, partial one, with what's going on at airports. So when you have no official data from the government because you're in a government shutdown, you have to use surveys. So this blue line is the ISM Services Price Index. Essentially, the Institute for Supply Management just asks companies, are you going to raise prices or cut them? And then they create a diffusion index. 50 is neutral. And so you can see from this blue line, which has been correlated to the CPI, right? That's this copper colored line. You can see that, at least as of a few months ago, this line was spiking higher. Now that we're adding the high oil price on top of this, we're going to be in an inflationary environment a little longer than we thought. So instead of seeing inflation maybe start to come down in February data or March data, it's now probably going to take, let's say, June or July data. We'll see how long oil prices stay high. But we're just going to have to be patient here and wait this out. And I think we're going to be in an environment where inflation is coming down in the back half of the year. And that's really important for stocks and bonds. Stock valuations are tied to inflation, and bond yields are tied to inflation, right? We want bond yields low, and of course, we want less inflation. And that leads to Fed rate cuts. So I'll get to that in a second. This is a chart I added. It is really timely. The US is energy independent, right? And so this allows us to weather this storm better than Europe or Japan or China or really any other Asian nations for that matter. The yellow line here shows you net imports. This chart goes back, what, 75 years? The yellow line is net imports of petroleum products. It's negative, right? We are exporting more than we are importing. And so that allows the economy to hold up better. In fact, actually, if you run analysis and you compare how corporate America does in terms of profitability in rising oil price environments or falling, it tends to do better than in rising oil price environments because we have energy companies, of course, making money hand over fist right now. So this is a way to make the point that the U.S. economy is going to hold up quite well, probably better than most of us expect it to, despite high oil prices. Now, if oil prices stay high for a number of months, then the risk goes up and you might impair growth some. But if this is just maybe a 6-week period of high oil prices, which is what the president has suggested it will be, we'll be back to kind of the old growth forecast, we think, maybe in the high twos. So here you go, 2.7% for US GDP. That is our forecast. That is a current forecast because we started the year at 2. We underestimated 2 things. Well, actually, probably 3 things. We underestimated how much AI investment we were going to get, right? We started the year thinking we'd get maybe 500 billion. Now we're looking at 600 plus from the big techs. We thought that the tariffs would weigh on growth a little bit more than they did. That it's hardly been noticeable. And then what didn't change is the fiscal stimulus because we knew that was coming. These bigger tax refunds are already arriving in people's bank accounts. So we still think we can grow 2.7% despite what's going on in the Middle East. It's also worth noting that Europe doesn't really have the tech sector as a driver. So they're probably only going to be able to grow at around 1. Japan, maybe a little better than that, but they are really hit hard by the Strait of Hormuz logjam and higher oil prices. They import basically everything they use. So it's probably going to be around 1% growth in Japan. So overall, US is still going to stand out. We have the innovation, we have the tech, and we have the energy independence that's really key. So think about 2% as really the floor here, right? And we could make a run at 3 if all goes well. So pretty solid economic growth outlook. It's just the inflation piece that we got to watch. And also the AI job replacement narrative is still out there. So it's probably going to be too soon in 2026 for meaningful job loss to come from AI. But we will probably see a little bit of that. And the job market has stalled. It's still not going to stop us from growing 2%. So constructive economic growth outlook. We just got to watch inflation. And hopefully it's just a few months more at most of this elevated inflation. All right, let's turn to the stock market. This is what I spend most of my time on. So again, same theme here, policy, which is fiscal stimulus, maybe the Fed, and then the AI investment. We think not only is it going to drive the economy, it's going to drive the the stock market as well through corporate profit growth, which is really strong. In fact, for those of you who are following the market closely, I listen to CNBC and Bloomberg Radio and such. I've probably heard, I'd say maybe 10 interviews where people express surprise at how strong earnings are still and how earnings estimates are actually rising in March. Think about that, right? What's happened in March? Well, the initial airstrikes were February 28th, right? It's been bombs falling for 25 days. And yet earnings estimates for the S&P 500 have been rising. And we're just about at the end of the quarter, so those are probably going to be pretty accurate. We're probably going to end up growing a little bit faster than current analyst estimates suggest. So that's really a testament to the remarkable resilience of corporate America. Now, I think because of some of these supply chain disruptions, we saw this during COVID, right? If people can't get fertilizer that's supposed to be coming through the Strait of Hormuz right now, you could have some disruptions for ag companies, for food companies, things like that. You could have higher costs or just supply chain issues that prevent product from getting on the shelf, things like that, right? You're going to have some of that, but that's not really going to affect the first quarter very much. So we think we'll have a strong earnings season. I'll get more into earnings in a minute. So this chart shows you what bull markets do by year. So we took all the bull markets since 1949. And we show you the returns year 1, year 2, year 3, year 4. The light blue bars are year 4. And look at how good these have been, right? So forget about 1949. We were down 2.3%. Who cares? That's a long time ago. We have been up 6 in a row in year 4, going back to 1957 bull. And the average gain in year 4 has been almost 13%. I just checked these numbers before we started the call. We're pretty much flat so far in year 4, which started on October 12th. So if this, I know averages, you have dispersion, right? You have some really good years, 28, 29. You have some not as good, right? 1990, we were in a recession, you had 1%. But if we're anywhere near this average, that means between now and October, you got some nice potential gains ahead of you. I mean, we believe that anyway, independent of this study, just because we think, again, we'll have some resolution in the Middle East over the next month or so. But this is encouraging, right? This tells you that even though we've had a nice bull market, it's now in year 4, it's not too old. It can keep going. So what ends bull markets? It's typically a recession, which we don't see, right? Again, I can't guarantee anything in this business, but it's very, very likely that we'll have north of 2% GDP growth this year, just because of those two factors I mentioned, AI investment and fiscal stimulus. You could have a hiking cycle from the Fed that surprises the markets. That could end the bull. We don't think that's likely either. Again, we need oil prices to come down, but we don't think the Fed's going to hike. And even if oil prices stay high for an extended period of time, they might look through that and not hike rates. It's a supply side problem, not a demand problem anyway. And so hiking rates wouldn't really help. In fact, it would risk worsening the job market, which is already kind of stalled out. So we don't think the Fed's going to hike rates. So that's not going to do it. We're not going to have another pandemic. I don't know if I probably was wearing a mask last time I spoke to you in 2021, or at least selectively. Not doing so much of that anymore. But I don't think we're going to have a pandemic end this bull market, and I don't think we're going to have a financial crisis end this bull market. So very likely that, we'll have a pullback. We're in a pullback now, probably have another one, but we still think we're going higher between now and the end of the year. So our forecast was for like 6-7% gains this year. We still think that's very, very likely. And in fact, we could do even a little bit better than that. That's a target of 7,400 on the S&P. So I mentioned the Fed a couple of times. If the Fed is cutting rates in a bull market, you've got really strong potential returns. Now, this is historical data. Of course, it doesn't always repeat, but when the Fed's cutting and the stock market's near highs, you have gotten on average 13% returns in the subsequent 12 months. So we've been in this environment, right? The Fed just cut not long ago, multiple times, and the stock market was near all-time highs when they were cutting. So we were in this environment. This is another reason to think, I mean, maybe we could generate 10% returns in 2026. Our forecast is a little lower than that, but based on this and based on the prior study I showed you, good chance that we are looking at north of 10% returns, assuming that oil prices don't get in the way. All right, so I mentioned AI a few times. Here is one of those charts that I mentioned where I left it in and didn't update it on purpose. Actually, I have an update to this. But I left it in because I just want to call out the change. So 2026 estimate, this is just these 5 companies, and I'm sure you probably could name them all based on the tickers. So actually, all of these are on the West Coast, right? They are indeed. So 2026 estimate coming into the year for these 5 companies was to invest $500 billion in CapEx, in building data centers for AI capability with all the chips and the servers and everything else. Massive, massive investment for only 5 companies, right? That was the consensus expectation coming into the year. Now the consensus is over 650 billion. So I think that's a 30% increase if my math's right. 30% increase in the expectation, which was already massive. So we're talking about 1% of GDP right here. Easy, actually more than that, right? That's going to help drive economic growth. And then I think that the one big beautiful bill is like 0.9% of GDP, something like that. These are just huge, huge dollars. So that is going to drive corporate profits. It's going to drive economic growth. All right, here's corporate profits. I put the numbers. This is a new chart, right? I just put this in yesterday, actually. So if you look at these sort of rust-colored bars, that is the Magnificent Seven, right? So the big 7 tech companies, and how fast are they growing earnings? So in Q4, which of course has already been reported, the Mag 7 grew earnings 26%, which is kind of about where they've been in recent quarters. That is a lot of earnings growth for some really, really big companies, right? It's the list I showed you on the previous slide, although minus Oracle. And you get, you add, of course, Apple and NVIDIA and Tesla. So the Magnificent Seven is growing earnings very rapidly. Now, what's changed a little bit this year is that we're getting a little more growth out of the rest of the market, what we call the 493. So in Q1, the Mag 7 expected to grow earnings about 19. Now, they'll beat those expectations. These are estimates because they pretty much always do, right? So our expectation would be somewhere in the 25 range again for the Mag 7 earnings growth. In Q1, we haven't started earnings season. The quarter's not even over yet, but that's a reasonable expectation. But look at the rest of the market. 9.6, that's really solid earnings growth if we can get it. Again, it's an estimate. Companies usually beat estimates. So good chance this number is 12-ish based on historical patterns. That means you could end up with mid-teens earnings growth for the S&P 500. That is really strong. So we're pretty optimistic that earnings, again, after we get through this conflict, will support stocks, and we'll have a solid 2026. Now, we know that the Middle East is a big risk, is a big wild card. Another one is the midterms. They're actually kind of related because President Trump doesn't want, $6 at the pump. Actually, I hate to even bring this up, but it's probably already there where many of you live. Here we're still under $5 in Boston. But if this goes much longer and oil prices go back to the highs from a couple weeks ago, you know, that could affect the midterms, right? Affordability was a big theme. We know that before this conflict started, and now it's probably even going to be a bigger one because not only are oil prices up, but mortgage rates are up. So, and then on top of that, this chart shows you that historically you get bigger drawdowns in midterm years. You get policy uncertainty affecting the market. Now, right now, we have war uncertainty, I guess, affecting the market. But as we get through the summer, at least on our base case, we'll probably have another bout of volatility. Hopefully, it'll only be another 5% pullback, or actually, the current pullback is 5.5%, I believe. Hopefully, it'll be just something like that, and we'll move on. But typically, you get these bigger drawdowns in midterm years. In fact, on average, you get about 17% down. We got 19 down last year in April. You don't always get it, right? We've had some years where we were only down like 2 or 3, and that was it. I think 2017 was one of those. But so we'll probably get more volatility around politics, but it's going to be later in the summer, we think. So that's just something to keep in mind. Although I'll also mention the average drawdown in a positive year is 11. That might surprise you to hear. If you just take all the years the stock market was up and then identify the biggest sell-off in each of those up years, the average is 11. So, you know, a 10% correction would be totally normal. But as you all know, the stock market goes up over time. And so you're still generating those average long-term returns somewhere in the 9 to 10% range in the S&P 500 historically, even though you have to ride out the ups and downs. So I think that's an important point to add there. And then last chart on stocks is you know, the geopolitical environment. How can you not go back and look at how the market has behaved in these events given what's going on? So I'll start with this. The reason that stocks have held up pretty well historically during geopolitical shocks, I'll call them, right? A lot of these are the start of wars, or big events. The reason that the market holds up typically is because a lot of these events don't affect the economy very much. So that's the lens that I use. I focus on what's the impact on the economy and on corporate profits. And so again, if this conflict is over in a few weeks, and the market can start to price in relative calm in the Middle East, then we're going to see the same pattern again, where you typically get a pullback, like less than 10% drawdown, not a correction, which would be more than 10%, typically. And it's, you know, typically over in a month. So that's what this scatter plot shows. It's showing how long it takes for the market to recover after these geopolitical shocks, and then what's the max loss? What's the biggest decline for the index at the lows following these events? Okay, and so to get a bigger correction, right? So let's call it 15, you need a recession, pretty much, right? Iraq invades Kuwait, well, that was a recession. It goes without saying that Pearl Harbor was disruptive. I don't need to tell any of you that. And then 9/11, we had a recession, right? 2022, most people think we had a recession. It was as close to a recession that didn't happen as we've probably ever had. What we had is more of a rolling recession, right? Where parts of the economy went into recessions at different times, and then at a high level, the overall economy didn't actually register recession the way they're officially labeled by the National Bureau of Economic Research. So we'll basically call that a recession, right? So those are the events that are harder for the economy and for the market to shrug off, right? But look at all these other dots, and I list all these events, you know, Kennedy assassination, Middle East wars, 6-Day War, Yom Kippur War, right? Reagan shot. I mean, these are a lot terrorist attacks, the Boston Marathon bombing, which certainly I'll never forget. Um, these are really scary events, right? And yet these are all the dots down here. What are all these dots down here, lower right? They're basically a month or less to recover the market decline. And the market declines are 5% or less. That's amazing. It's really, really impressive resilience. So think about it through the economy and through corporate America when you're trying to assess potential impact of what's going on in the world here. So hopefully that's helpful perspective to, for those of you who've gotten nervous. I mean, I think all of us have gotten a little nervous here recently. If you just look back at the history, it's really reassuring in terms of how markets shrug these events off. Almost always. All right, let's go to bonds and then we'll stop here. So we call this navigating neutral, which I told our fixed income strategist who came up with the title that I thought it was terrible. But he originally had Jekyll and Hyde as his title. I think he's used that elsewhere. And I think that one fits. What we have, or tug of war, what we really have in the bond market is a tug of war. So what started as, okay, we're going to wait for inflation to come down, and then rates are going to come down, balanced against the debt and the deficit, which puts upward pressure on rates, right? That's where tariffs come in, right? The tariff revenue is helping offset the stimulus spending. So the deficit's not really getting much worse, getting a little worse, but it's really not getting that much worse. So it's tug of war, right? Debt deficit pushes rates up. If inflation comes down, pushes rates down, tug of war. Well, what kind of breaks the tie? The Fed. So the Fed doesn't control long-term interest rates, right? They just control the short-term rate, but they are connected. So that's what this chart shows. You can't just look at the Fed funds rate, which is a range of 3.5 to 3.75, and expect the 10-year yield to be there and expect obviously your mortgages to be there and all of that. The 10-year yield looks at where the Fed will eventually go. Okay. So right now, that's what this trend shows. So right now, the market is saying no cuts. We expect cuts, one or two, but the market is saying no cuts. Okay. So that leaves us at 350, which is right here. So if you follow the plot over to the left axis, that's like a 440, 450 10-year. Well, guess that's pretty close to where we are now, 433, right? This is why cuts are so important. If the market thinks that the Fed is going to go to 3, which was the expectation a month ago, and with the new Fed chair, we still think we're going to get there. It just might be early 2027. But we think we're going to 3. And maybe a little, that's the neutral. That's what I mean, or what Lawrence, our chief fixed income strategist, meant when he said navigating neutral. The Fed wants to go to a rate where they're not really stimulating the economy or restricting it. Right now, they're restricting it a little, we think. And I think that's generally the view of most folks on the Fed, especially the incoming chair. And Stephen Myron, who Trump just put on the Fed just a few months ago. Right. So if you think we're going to 3, which we do, or certainly 3.25, then you're talking about 10-year yield under 4.25. So we think the Fed will help get the 10-year yield below 4.25 by the end of the year, and that can get mortgage rates back under 6, and the stock market should be comfortable with that. Now we need the tariff revenue, which we're probably going to get because it's just the tariffs are going to be put back on. They've already have been put back on. So that tariff revenue will help keep rates down by keeping the deficit stable. And then you need that inflation piece to come down, and then you'll set up rate cuts. So that's our view. 1, maybe 2 cuts this year, and then we'll get maybe another cut in 2027. We'll see. So I will go ahead and stop there. I'll show you these lovely disclosures. Press isn't the only one that gets to show you disclosures. And then we can do Q&A. So thanks so much for your attention. I hope that was helpful. Hopefully I covered a lot of questions that you may have had maybe before I started talking. And thanks, Allison, for having me back.
Yeah, well, thank you again for a really interesting perspective. You know, I meet with clients all the time, and there's a lot of, I think, questioning and fear runs rampant these days. You know, I think through everything that everybody sees and feels every day. So I really appreciate you presenting a sort of a measured, data-driven approach, because it is truly, you know, not an environment anymore where you can read what you're reading on the news or hearing on the radio and knowing that that's actually true or accurate or complete. So I feel like your team looks at all of these data points in a very objective manner without a tilt. And so that really, really helps, I think, as far as confidence. So thank you again for being here and taking your time in an evening away from your family. I really appreciate it. Yeah, so you touched a little bit on the Mag 7, and you talked about the S&P, you know, and a few buzzwords, but thank you for explaining those. What about the sectors? You know, people hear large cap, mid cap, small cap. We're looking at that stuff all the time. There's growth, there's value, there's all the different things. So can you talk a little bit about your feeling on the sectors of the market, and maybe highlighting a couple of specific ones that I get questions on a lot are gold and crypto, and what's up with all that stuff?
Yeah, sure. Uh, Boy, it's a really interesting environment now because some of this stuff hasn't really been doing what we or others might have expected it to do, right? Like we've had the big sell-off in gold. We actually think gold is really interesting right now. And so we have an investment committee meeting every week. Of course, we talk amongst the team more often than just once a week, but that's where we really debate investment ideas, and gold came up, and you know, that may be an area where we get more constructive. So I think that's a really interesting place to be now that we've had this big sell-off. The central banks are buying around the world, are buying a lot of gold. That's providing support. You know, again, we just need to get through this elevated oil price, elevated interest rate environment, and I think you'll see gold start its ascent again. So that's that one. I mean, crypto, I guess. I mean, it's not an area that I spend a lot of time on, to be perfectly honest. We do have some ways through LPL that you can invest in it. What I just tell folks is be really be careful with your sizing, right? Like this is not the type of thing where you'd say, okay, it's like small caps. Give me a 10% position. No, please don't do that. Right. It's, you know, I mean, personally, I have some exposure in my own account. I have about 1%. I think that's a pretty good number. And then kind of follow it and see how it does. And, you know, maybe you're kind of with gold. Similarly, I typically keep my gold exposure under 5%. Sort of you know, shooting for like 2 to 3. I think that's reasonable for folks. Now, the alternative investment space has a lot of different flavors to it, right? And so if you want to do some other additional alternatives that can help smooth out the ride and be less volatile than stocks, and maybe hold up well when bond yields are rising, there are a lot of places to look, right? And so if you throw all that together, it might make sense for somebody to have, you know, even north of 10% in alternatives, maybe even 20, depending on where you are in your investment cycle. So, that's how I'd think about that. Kind of, you know, a couple points to maybe 10 plus, depending on how you define alternative investments, or commodities are part of that and the way we define it. In terms of like other, you know, sectors within the equity market, we did recently upgrade our view of the industrials sector. So for those of you who, who use ETFs, and or just have, some extra money laying around and you want to kind of buy this dip, which I did a little of personally, um, last week. I think industrial is a really interesting place because it's a tangential AI play because when you build a data center, you need industrial companies to do that, right? It's not just the tech companies. And then, another example is like you need industrial equipment to cool the servers, right, that are running hot. That's a huge expense, frankly. So industrial companies do that. We have the fiscal stimulus that I mentioned several times. There are business tax incentives. I'm sure many of you are aware of this in the One Big Beautiful Bill that are encouraging more investment in capital equipment, right? Expensing, depreciation benefits, things of that nature. So I think that's going to be good for the industrial sector too in the coming months. So I would highlight that. And then remember, we've been trying to nearshore or bring, manufacturing back to the US. I mean, I think it was even really before Trump 1.0, but he really shined a light on it. The pandemic shined an even brighter light on it because we need our supply chains here. And what's going on in the Strait of Hormuz now is highlighting how lucky we are that we're energy independent. We have our energy supply chain here, right? So we don't have to worry about disruptions overseas so much. I think the nearshoring trend is only going to get stronger. It's been pursued by Republicans and Democrats, right? The CHIPS Act was done under Biden, right? So it's not really partisan issue, I don't think, bringing manufacturing back. So and the tax code is encouraging that too. So we think that's good for industrial. So that's a sector. We still like tech enough to be market weight. That's a huge weight. Tech, some of you might not know this. Tech is 33% of the S&P 500.
That's huge.
It is a huge weight. So if you're market weight and you've got 33% of your equities in tech, the way we look at it is, wow, let's make it a pretty big bet. So we're not comfortable going overweight yet, but I will say I do expect tech to outperform on the other side of this conflict. So that's another place that you could look. In terms of the other asset classes, like we like large caps a little bit better than small right now because that's where the earnings growth is, and that's where the strong balance sheets are. A lot of companies are able to take advantage of the environment we're in with the stimulus. So we think large caps are a good place to be. We don't really have a lot of conviction on, growth value. We don't really have a lot of conviction on international versus US either right now.
Interesting.
But I will say during this conflict, the US is probably going to outperform because it lifts the US dollar, which reduces returns on international markets. So plus, as I mentioned, Europe and Asia are really dependent on oil through that strait, and therefore they're experiencing more economic pain than we are. So again, during this conflict, you're probably going to see the U.S. outperform, but then on the other side, it'll likely flip back. International has been doing quite well. So we believe in diversification now more than we did in the last 10 years. Right? The last 10 years, you really didn't want diversification. You just wanted to ride the S&P 500. We have now moved into a different environment, right? International started to do better. So we have diversified the portfolios that we manage more so as a result.
Interesting. So you mentioned the investment policy meeting or the investment committee meeting. What happens in that meeting? It's an interesting, I know what used to happen. A lot of our clients that are on the call today were old Waddell and Reed clients. And so I know what happened in Hank Herman's investment meeting every morning, the morning meeting, everybody was terrified of. But what happens in your morning meeting?
Yeah, I met Hank Herman.
Oh, yeah?
Because I grew up in Kansas City.
Yeah.
And my father knew him.
Oh,
So
fun.
I can relate to your comment.
Yeah, yeah. My
Smart.
partner Elizabeth, who I came to San Diego to help her retire, and some of the clients on the call today were her clients. She and I were the only advisors from the field invited to Herman Fest when he retired. So I
Wow.
still in my kitchen have my Herman Fest mug.
That's amazing. That's amazing. Yeah,
Yeah.
as someone who grew up in Kansas City, Waddell and Reed has a special place
Yeah.
in my heart. So that's kind of a neat sidebar. But anyway, so what happens in these meetings? So we have subject matter experts across all the different types of assets. So our head of macro strategy, Christian Kerr, just goes around the table. Let's hear from the equity guy. Let's hear from the bond guy. Um, Actually, the technicals guy, Adam Turnquist, he does a lot more than technicals. But what I think is interesting about hearing from him is that I'm more of a fundamental guy. So I think more
Mm.
about how are the companies doing, what are their earnings, what should the PEs be, and those sorts of things. Whereas he just looks at price charts and volume,
Interesting.
right? And patterns, market. He looks at more than that, but a lot of what he looks at, market patterns,
Mhm.
and moving averages and things like that, right? And so I think we complement each other well. So Adam talks, I talk. It's gosh, how many of us? We have a quant guy who talks. I guess it's five.
Mm.
We go around the horn and five people present what they're thinking, and then Christian brings up uh, quant ideas. We
Mhm.
have actually there's it's I'm going to be understating it, but we built this quant model that kind of boils all the numbers down into a ranking. And
Okay.
so it's technical and fundamental. So we come in every day and we can see what's tech ranked or what's emerging markets ranked or what's large growth ranked or even bonds, right? Treasuries versus corporate bonds. What are they
Mhm.
ranked? And that's the sort of foundation for the discussion. So Christian will flag things. Hey, I noticed this. What do you think? And then we go kind of around the horn and everybody works in whatever the sort of hot topics of the day are.
Mhm.
At the meeting this week, it was obviously about what's going on in Iran, and we just
Mhm.
kind of shared what, would we buy this dip? When will we buy this dip? What are we looking for? We came away with kind of waiting. I think patience makes a lot of sense here
Mhm.
because I mean, there's no deal. It's going to be tough to get a deal. Uh, it's going to be hard for President Trump to just walk away and leave a mess behind. Um, it's going to be hard to get some sort of like a peace guarantee.
Mhm.
Um, I mean, we know as long as I've been alive, there's been wars in the Middle East too regularly.
Mhm.
Um, so I think anybody who thinks this is going to be sort of peace in a couple of months and then we don't have to worry about it anymore, that's probably
Probably a
naive.
little.
It's just a matter of how messy it is, I think. So
Mm.
the fact that it's going to be hard for us to clear the strait without sending, having soldiers on the ground. That's the part that makes me a little nervous. So, and we know that Iran's missile range is longer than we thought. So and frankly, they've done a lot of damage already, including to uh, Qatar's liquid natural gas plant,
Mhm.
which is a really big plant. I think it's the biggest in the world, right? So they can do a lot of damage. So we really need to get to a ceasefire and get to calm. And it's unclear to me exactly how that happens, which is why we're really not interested in doing anything more than neutral. So we're benchmark
Mhm.
risk right now in our models, and our next purchase would put us overweight equities, would put us overweight risk. That's the
Mhm.
decision we're trying to make. For those of you who are already positioned conservatively,
Mhm.
probably would buy this dip, right? But we're already fully invested at our targets. It's a little bit uh, higher bar to clear to get to an overweight stance.
Well, that is really interesting to me. I'm sure it's interesting to the folks on the call as well.
I hope so.
Yeah. Yeah, thank you for sharing that. And I think that that is really valuable, just sort of insight and perspective on the rationale behind the process. It's not what you see on TV and, people jumping around just, doing stuff. It's very deliberate. And thank you for bringing in both sides of that, the data as well with the PEs and then the price, because I think both of those are important, and I'm by no means the expert on any of these things. But yeah, Peter, my partner, who's the stockbroker, and then we'll wrap up. He has me reading this book.
Oh, sure. So
Apparently, I need to know these things.
That's
So,
the chart. That's the
yeah,
chart stuff. I'm
that's the
familiar
chart
with.
stuff.
I don't
Yeah,
know how to interpret it, but I'm familiar with point and figure.
yeah,
So that's Adam. When it's relevant, Adam will bring point and figure charts to the team. So that's
nice.
funny.
I like that. Well, thank you again, Jeff, for taking your evening. I really appreciate it. All right. If you have any other questions, please feel free to give us a call, email us. Hopefully this has been a helpful insight. And again, thank you so much for your time on this lovely Wednesday afternoon. Have a good one and take care.